Good evening, friends. We have the privilege to have with us Mr. MP Vijay Kumar, a chartered accountant by qualification, a member of the Central Council of the Institute of Chartered Accountants of India for about 6 years till 2022, and a member of the IFRS, International Accounting Standard Revision Board, and also a member of the IFRS Advisory Council and IFRS for small and medium enterprises. And apart from his professional independent directorships with LIC of India, Geojit Financial Services, Heritage Foods, and Cella Software Services Private Limited, and many more. Of course, you all know that he has been a renowned author on the specific topic of accounting standards nearly more than a decade back, and has been a favorite among all the students, at least from Chennai, who had attended the institute classes. So they would have heard him a lot. So I'm happy to have him with us today, despite his busy schedule, to address on a very important topic of climate change and the reporting requirements under the various accounting standards. So he's going to enlighten us on that. Thank you, MP. Over to you now.
Arun, thank you. Vineet here. I just wanted to add that you were right. I think all of us, doing our chartered accountancy that time, have heard sir's name. I, being in the other region of India, did hear a lot of people, getting coaching from him, and they have established practices and setups now by in their own way. So, and I think sir is a guiding authority in the standards and everything related to it. So it's a privilege to have. Thank you, sir.
Yeah, thanks, Arun. Thanks, Vineet, for those very kind words of introduction. And equally, thanks for the opportunity to interact with the members of the PENG on a very important topic, a contemporary topic, that is implications on financial statements because of the various commitments which organizations make towards sustainability, and the commitments which they talk about based on the impact of climate on their respective businesses, or the impact on climate because of their business operations. For a learned audience which we have, the change in climate and consequent impact on the overall economic growth or on the respective businesses, I don't think I need to delve into it, because at least in the last couple of years, there has been a substantial amount of discussion on these topics, both within the boardrooms of organizations, executive teams of organizations, and even in various public fora. In fact, the last couple of years, I can't recollect a single large conference where there has not been a topic around either ESG or environment or sustainability or renewable energy and the like. So what I would do is I'll confine myself for this session on highlighting the impact of climate-related matters on the financial statements, the accounting implications of the same. And just a small caveat as I go forward, all of these views are my personal views, even though I'm part of IFRS Advisory Council, the advisory board or the council which advises both the International Accounting Standards Board and the International Sustainability Standards Board, where my view, ISSB has done an exceptionally good job of within a short time coming up with two standards and getting them off the ground. I think they have done a phenomenal job. So none of what I speak now should be seen as views of the bodies with which I am presently engaged. We're all aware that the climate change is real, and the impact of climate on business is pretty well acknowledged, be it in the supply chain or the customers' buying pattern, buying preferences, or the overall addressable market for an organization. I do know of business. Well, let me take a very simple example. If I were to take a market like India, and I recognize that we have participants from beyond India as well, and sincere thanks to all of you for having taken time to be here now. If I were to look at the current younger generation, they have a very clear preference for a electric vehicle versus a ICE vehicle. Even though an ICE vehicle would give a much better kind of a performance standard, lesser anxiety towards the distance they can travel, they all have shunned the petrol or diesel vehicles, and they're showing a very high preference towards electric vehicles. We are witnessing that in the two-wheeler market. We are seeing that even in the passenger car market. So the addressable market itself is changing. The consumers' preferences are changing. The market itself is changing. The production methodologies are changing, and availability of labor as well. In fact, I don't know how many of you would have actually experienced this, but I do come across many such instances where the younger generation, the guys in the age of 21, 23, 25, they have a very strong preference for joining organizations which have a very good stated policy and implementation practice, which is committed towards ESG practices. In fact, there are many youngsters who are very keen that only if the organization has such good practices or the activity which they are doing, if it is not harmful to the environment, they're willing to join an organization. So all of these impacts, we are all seeing it. We're all seeing it. So given the fact that there is an impact on all of these things, how do we apply the present set of accounting standards? And since we have the benefit of the members from beyond India as well, I'll speak around IFRS. IFRS in India, it is Ind AS, and IFRS in India is for all practical purposes are one and the same. In these slides, there is also reference to accounting standards. For those outside of India, in India, we have two accounting frameworks. One is Ind AS, which is the same as IFRS for public interest entities. And equivalent of IFRS for SME, we have a separate framework called accounting standards, which was also historically developed based on the then international accounting standards. So both of these accounting frameworks, or even IFRS for that matter, do not have, I reiterate, do not have specific references to climate-related matters or accounting for the climate-related impact. But almost all of the standards have enough guidance on how do we consider the impact of climate in the financial statements. At the International Accounting Standards Board, one of the board members had written an article about 2 years back highlighting this, and the same is now converted after due deliberations at the board as an education material, which was published sometime in June or I think July 2023. It's available in the IFRS Foundation page. So it is available as an education material. And while education material does not have the authority of a standard, it's still considered as an active guidance to be followed by preparers and the auditors as well. So the education material lists down specifically that the current accounting standards, namely IFRS, has adequate provisions on how the impact of climate change should be considered in the financial statements. Let me at the start draw your attention to an extract from annual report of a European company, Rolls-Royce. This is from the notes to accounts, and this slide, this particular page will help us get a good understanding of how a similar kind of a note should form part of financial statements of the various organizations each of us here represent. So what I've just highlighted the relevant portions. I'll read the first two lines verbatim, and it's important to recognize the same. It says, quote, in preparing the consolidated financial statements, management has considered the impact of climate change, particularly in the context of the disclosures included in the strategic report this year and the stated net zero targets. All of us, at least those in India, we all know that whether it is the board of directors through the director's report or the chairman through the chairman's speech in the annual general meeting or the chief executive officers in their various IR communications or otherwise in the respective web pages or to the customers and vendors, there is a communication done by almost every organization that we are taking steps towards reducing our carbon footprint. We are taking steps towards moving to a net zero target, 2040, 2050, 2060, some of them 2030 as well. So while all of these statements which come from the board of directors through a director's report is a legal document and a legal communication made to the investors, it's a binding promise. To a similar degree, the remaining also apply. So what this Rolls-Royce communication says is, as part of a separate document called strategic report, not financial statements, through a separate independent document, there is a commitment made by the organization towards net zero. So this particular commitment which is done, be it 2030, 2040, whatever be the period, the actions for that begin now, whether it is in terms of redesigning the production process or giving up certain product lines and looking at new product lines, giving up an existing market, looking at new market, so many other aspects. And all of those, they don't begin in 2040, but they begin now. And they happen progressively over a period of time. So the same notes to accounts below, and I'll read it verbatim. The group continues to invest in on-site renewable energy solutions for facilities and investment, which is part of our 5-year forecast to meet our 2030 target of greenhouse emissions, both scope 1 and scope 2. And it goes on to say, the management has considered the impact of climate change on a number of key estimates within the financial statements, including estimates of future cash flows for impairment assessments, estimates for recoverability of the deferred tax assets, and long-term contract accounting assumptions. So for the respective organizations we all work for, it is unlikely to be different. But if we were to look at our own organization, financial statements for 22-23, none of us would have a similar note as part of our notes to accounts in our financial statement. And in India, we have taken the step of the capital market regulator SEBI, making it mandatory for the top 1,000 listed companies by market cap to publish a report called Business Responsibility and Sustainability Report. And as part of this BRSR, which was initially voluntary for 21-22, and a good number of companies actually published it when it was voluntary, and for 22-23 when it is mandatory, and for 23-24 onwards, it is beginning with an assurance as well, initially on comply or explain basis, and thereafter mandatory. And if you read almost all these organizations' BRSR, along with their director's report and chairman's speech, every organization has made substantial commitments towards the net zero targets. And all of that have an accounting implication exactly similar to what you're seeing in this page. And a similar notes to accounts also needs to appear in our respective financial statements. Now, as far as the standards are concerned, as I mentioned to you, read wherever I say Ind AS as IFRS, they're literally the same. So whether it is IFRS or the equivalent in India, they do not refer specifically to climate-related matters. If you do a Control F or a Command F for the entire IFRS literature, you will not find the word climate-related matters anywhere in any of the accounting standards, any of the reporting standards. But if you read the language of various standards, they do contain paragraphs. They do contain paragraphs which require us to consider climate-related matters and make the necessary accounting, which includes recognizing at times in the financial statements, consequently presentation, and measuring it appropriately, or making the respective disclosures. While talking about this, I want to highlight one specific aspect for clarity. Some of us might have a question that there are these sustainability standards which the IFRS Foundation is issuing through the ISSB, International Sustainability Standards Board, and you have this financial reporting standards which are also coming from them. So will these aspects not get covered in the sustainability standards? And these sustainability standards are not mandatory as yet. So why do I break my head on these few pages which we are going to talk now? The answer to this is very, very simple. The sustainability standards will limit itself, will confine itself only to disclosures to be made. The sustainability standards which will be issued by ISSB will not deal with recognizing, measuring, presentation, or disclosures in the financial statements. The sustainability standards, two standards issued till now, they will be an independent report outside of financial statements, independent report outside of financial statements, and their boundary is only disclosures. So, if some disclosures were to be done there, they will obviously trigger some accounting here. That's a different part. But independent of sustainability standards, you will have from the existing accounting framework, the recognition, measurement, presentation, and disclosures. And please note, IASB is not going to take up any project in the immediate future for incorporating specific provisions on how climate-related matters should be considered in the financial statements. After a lot of deliberation, the IASB's conclusion is that the existing IFRS already covers all of these things. There's no need for making any amendments. And consequently, they have come out with this education material, and it is binding upon all of us, whether we follow IFRS or we follow Ind AS, the equivalent of it. Now, what does Ind AS 1, which is IAS 1, the equivalent of IAS 1, para 112, what it says specifically is a requirement of disclosure of information which is not specifically required by an accounting standard. Accounting standards, many of us look at, there are these 15 disclosures in IFRS 9, there are these 12 disclosures in IFRS 10, there are these 13 disclosures IFRS 12. So we have the checklist-based approach. No. The standard says, even though it is not specifically required by any of those standards, and it is not presented anywhere else in financial statements, but if you consider it relevant for understanding of financial statements, it is incumbent upon you to make the respective disclosures. So disclosures do not follow the list which is listed down in those respective standards. In fact, most of you will be aware that IASB is now moving towards a disclosure project where they are going to do away with all these individual disclosures, and the disclosure decision will become principle based, where you have to decide based on the materiality, how it affects a user of financial statements decision making, and decide disclosures to be made. So it is from that context that this para 112 of Ind AS 1 or IAS 1 requires disclosures to be done. Now, the standard IAS 1 has a specific paragraph which says that while preparing financial statements, the sources of estimation uncertainty and significant judgments should be disclosed in financial statements. So if you look at financial statements, the whole of financial statements are only estimates supported by judgments. There is nothing in financial statements which is called cash, which is called actual. Nothing in the financial statement is an actual number. Whether it is property, plant, equipment, net of estimated depreciation, or investments, financial instruments at carrying values, which could be fair values, or liabilities, which could be taxation, retirement, or other liabilities, all of which are estimates and fair values. Even something like cash and bank balance, if it is held in foreign currency, that is also an estimate. So financial statements in totality are subject to plenty of estimates. If you look at income statement as well, when you apply IFRS 9, IFRS 15, in terms of unbundling, recognizing revenue, etc., there is estimation. Cost of goods consumed, depending on first in, first out, weighted average, that's also an assumption, an estimated number. Depreciation in income statement is estimation number. Your borrowing cost is also an estimated number, effective rate of interest, depending on currency of borrowing, etc. Employee cost, considering stock options and retirement benefits, estimation. So, and the final net profit is also an estimated number which goes and sits in equity. So the bottom line is financial statements are full of estimations and judgments, and IAS 1 has this requirement of disclosing all of the estimation, uncertainty, and significant judgments. And while making that, wherever climate-related matters impact your estimation requirements, you need to make a disclosure of the same. Like for example, while arriving at your useful life, there could be a regulatory requirement that this particular asset, this particular equipment is not environment friendly. While it could have a residual life of 15 years, you are required to retire it by 2030. That could be a regulatory requirement. Or it could be your own commitment, like what we saw in Rolls-Royce. Your own commitment for 2030 net zero commitment. It is not energy efficient. While it can have a residual life of 15 years, because of my 2030 commitment, I should confine my amortization period to the next 7 years. So all of those estimations should be considered. That's the requirement from IAS 1. The same is with reference to the going concern aspect, which is covered in IAS 1, which going concern assumption requires you to take a view of the organization's ability to continue in the foreseeable future. And there could be certain industries which the government could be extremely sensitive to, and there could be regulatory changes already being contemplated or likely to be issued, or there could be a market force change itself. Take the case of automobile companies. If somebody had set up an automobile manufacturing company 3-4 years back on combustion engine basis, ICE, that particular entity can by no stretch of imagination scale. Those who have been doing it for a long time will have their own plans of shifting over a period of time. But those who are finding their feet, for them, going concern itself is a question mark. So you need to assess the going concern depending on how the climate-related matters are going to affect your business, whether it is in terms of supply chain or whether it is in terms of your customers. And on supply chain, very important part, many of the organizations are suppliers to larger organizations. They manufacture spare parts or components for a larger organization. The larger organization, as part of their scope 2 requirements will require these units who are suppliers also to be a sustainable organization. So I could have a particular business model which involves probably excessive usage of water, or the business model could be a very energy inefficient business manufacturing process. So those cases, it is most likely that my customer will give up on me in the next 12 months and look at alternate suppliers. So my ability to continue itself gets affected. So I need to make that assessment of going concern as well. Similarly, on inventory, IAS 2 requires this inventory to be carried at lower of cost and NRV. And while determining the NRV, the climate-related matters will have an impact on whether that inventory will realize the true value, whether that inventory will become obsolete because of the weather conditions which have changed. And in India, we have witnessed almost across all parts of the country, at least in the last 4-5 months, I can very boldly speak across the country, there are periods when we never expected rain, but there have been very heavy rainfalls, and there have been very high levels of temperature as well, and climate has not been the same as what it has been in the past. Consequently, the shelf life of some of the products, etc., all of those undergo a change. So that impact needs to be considered, and that is already covered by IAS 2. You don't require the standard to be amended to tell you that consider the impact of climate while arriving at your NRV. Similarly, on taxes on income, many of us might have a deferred tax asset which we can realize based on the future profits. But the future profits is a function of my ability to carry on the business and generate those respective profits. As you saw in the page of Rolls-Royce, you need to see whether the climate-related impact, how much impact it has on your profitability of the future and the ability to recover the deferred tax asset or the prepaid tax which you have now paid. So that should be considered as per IAS 12. And at the cost of repetition, IAS 12 does not have the specific expression climate-related matters, but it requires you to consider the future taxable profits which you're likely to generate. And while estimating the future taxable profits, you need to consider the impact of climate on your business and the regulatory environment of climate on your business and your own commitments which you have made for the business while carrying the deferred tax asset. Same applies to property, plant, equipment, IAS 16, International IAS 16. And this particular standard as well, whether it is relating to the value of asset to be capitalized, how much to be capitalized, or the estimated useful life or estimated residual value. In the past, assets which I capitalized, let's say 5 years back, I expected a residual value of, let's assume, 5% of the original cost. But now, because of the ESG related regulations which have come up, climate related regulations which have come up, maybe that particular 5% residual value is unlikely to be there. So the standard already requires you to do an annual assessment of the remaining life. The standard already requires you to make an annual assessment of estimated residual value. So while doing that annual estimate, you need to consider the impact of climate-related matters and arrive at the quantum of depreciation or amortization which needs to be considered. Similar is the case with impairment as well, IAS 36, impairment. And on impairment, established organizations who have been there for 20, 30 years, who have 7, 8 manufacturing plants set up over a period of time, different parts of the country. And these plants, some of which set up 30 years back, set up 20 years back, 10 years back, they would have their own inefficiencies with reference to the carbon footprint. So those assets, you may not be able to continue the same way because your customers are asking you, are forcing you to retire those assets. So those factories, I need to put them through an impairment test, keeping in mind the kind of impact on the carbon footprint which I am generating and my own commitments to reduce that carbon footprint and accordingly impair the assets. So all of this needs to be considered. Then, and this emission reduction regulation is very, very common in many jurisdictions. Same is the case with IAS 37. IAS 37 provisions, contingent liabilities. The standard requires a disclosure of the nature of provisions of contingent liability and what are the uncertainties which are considered for that. And these climate-related matters which are likely to result in a provision or which could be a potential contingent liability, we need to factor in the levies which are likely to be imposed by government if you fail to meet the climate-related targets. So the regulatory environment could be that you have to reduce your air pollution impact, water pollution impact, etc. before 2027. If you don't do it by then, this is the penalty. And if you don't do it by 2030, then you have to close down the factory. So those kind of regulations which are there, we need to assess it, make suitable provisions or contingent liabilities for those. Similarly, the regulatory requirements might also require us to take some steps towards remediating the environmental damage which is there. So these requirements may not have existed 15 years back when I set up the factory. But today, the law requires that when the asset is retired, you should ensure that the environment impact is not there. You have to plant the trees, set up equivalent number of trees, generate, whatever they may say. All of those come at a cost. That particular cost you have to incur for remediating the environmental damage you are causing, that particular impact. Also, you need to start accounting from now. Just like these are all like asset extinguishment liabilities, you need to start providing for the same. There could be some contracts which might have become onerous because of the climate-related changes, or you might have to take a restructuring or redesigning of your existing plant, existing factory, existing products or services because of this climate-related changes, and the cost of such restructuring, that cost of such restructuring will be covered by IAS 37, and the needful accounting is to be done. Coming to IFRS 7, financial instruments related disclosures. There could be banks, investment houses who have a loan portfolio, lending portfolio, loan portfolio, and this loan portfolio which you have given it to all kinds of industries. Some of those industries are highly vulnerable for this climate-related regulatory changes. So for such loans, which are 10-year loans, 15-year loans, the risk is much higher. So when you calculate your ECL provisioning, you need to make that macro adjustment again and say that I am funding a particular sector which is energy intensive, currently on coal-based projects. So those cases, I need to look at, should I make a higher amount of provisioning for the credit risk? For the holders of equity instruments, similarly, while arriving at your fair value estimations and all, you need to look at how much of the investee companies' operations are likely to be impacted by this climate-related matters, and consequently, the fair value of the investments which you hold. Where they are the observable market, it's a different matter. Where there's no observable market, unlisted entities and all, where you adopt your own valuation models, you need to factor these while arriving at the suitable disclosures. Similarly, IFRS 9, as a borrower, I could have borrowed some money saying that this particular loan is for meeting some pollution-related standards or meeting certain environment-related standards. And the terms of the loan are that it carries a coupon rate of 6% if you achieve these objectives. If you don't achieve these objectives, the coupon rate becomes 12%. So that particular assessment is required. And I am increasingly seeing conversations where banks, out of the green bonds which they have raised, or mutual funds out of the specific ESG related schemes which they're raising, are having these kind of covenants in the loans which they're giving to enterprises. So when I borrow that money, so the rate of interest I should apply for my income statement, should it be 6% in the example I gave, or should it be 12%? It depends on how I'm meeting the covenants, the probability of meeting the covenants, the judgments which I make or the estimates which I make. All of this is already addressed by IFRS 9. IFRS 9 will not require any amendment to be done to tell us that consider the climate related matters also. That is not required. Same is the case with the fair value estimates to be done. IFRS 13. So IFRS 13, when we do the level 3 valuation in particular, and in practice, most of the assets we value are all level 3 valuation. Very few assets you get to apply observable market level 1 or apply level 2 and adjust suitably. Most cases, it's a level 3 one. And when we do those level 3 valuations, you need to consider the impact of the climate related matters, which can be a regulatory requirement on you or a customer impact on you, or with the other commitments you yourself have made. All of those you need to consider while doing the valuation. Last of the recent standards, IFRS 17 on insurance contract. So this contract also requires, when you're measuring your insurance contract liabilities, there are insurance companies who are looking at general insurance companies who are giving, let's say I give a loan to a unit which is in Uttaranchal, a northern part of the country, which is the mountainous part and all. We have seen how much of soil erosion is happening and consequently impact on the losses which are happening because of the assets getting damaged, whether it is houses, offices, etc. getting damaged, and the insurance companies are required to compensate for that. So when they do their actuarial valuation, they have to consider that because of this climate related changes, there are so many assets which are susceptible for a higher losses, higher frequency of losses, or an early loss. And all of that needs to be factored in the insurance pricing as well as the insurance liability accounting, which needs to be done. I have extracts from a few annual reports. I will share the slide deck with you, similar to the one which we had on the Rolls-Royce page. All of these annual reports, all of them are European companies or Australian. I think I have one or two Australian companies as well. All of these are extracts from the notes to the accounts, notes to the financial statement. Please recognize they are not from the communication outside financial statements. Whatever are the pages which I just flipped, all of these are part and parcel of the audited financial statements. So when the preparer prepares, CFO signs off, audit committee recommends, board approves, these financial statements will include all of this, and the auditor also has to sign off on this particular notes to accounts as well. So that's it on the impact, and maybe I'll pause here. The slides have a few supplementary slides on the IFRS sustainability standards 1 and 2, but maybe some other occasion we can see. I think we should have a quality interaction for at least 10 minutes. So let me pause here, but at the cost of repetition, I have one important observation to make. Every organization I am coming across is making some commitment or the other towards net zero. Some commitment, whether it's 30, 40, 35, 50. So as accounting professionals, we are duty bound to consider it, even though those commitments are made in other places, director's report, BRSR, website, etc. Please note, these are all communications to the investor community, and it's a promise, it's a constructive obligation which you are take upon yourself, and all of those needs to be considered in the financial statements as well. I would actually recommend that executive management should spend time, not be in a hurry to make those commitments of net zero. The head is not going to go off until we get a complete control of what is the cost and the implications of P&L equity market cap. We should not make those commitments. We have to be very careful on making those commitments and deciding the timing of making those commitments. So I'll pause here and thank all of you for your participation, and both Arun and Vinit for the opportunity to be here today. Over to you.
Wow. That's a lot from you. I'll just quickly go through the question that has been posted in the chat box, starting with the first one from Bhagwan Thamanna. I hope I spelled it right. So what is the impact of, whether we should consider the impact of El Nino situation on agricultural industry as a best example, and disclose accordingly the impacts of these climate conditions.
Yes,
I think we're talking about the El Nino and the four-yearly change weather pattern.
Let's look at companies which are very active in food products, and their sourcing of raw agriculture produce. It does get affected, both in terms of the availability, quantity and quality. And we have seen in India itself, there are times when certain food products run into scarcity, and there are certain food products which are heavy water consuming food products, and the local ecosystem, they don't allow you to have those kind of food products to be planted. raw produce to be planted. So all of those have an impact on the cost of products to be available. There is only so much you can pass on to the customer. And there could be a situation where customers might say that, look, this food product is made out of raw material, which consumes excessive water, so I don't want to touch it. So which means that food product line itself could become impaired. So all of those effects needs to be considered. Good example, which is there.
Okay, I hope she got her answer. Second question is from Surya. There is a carbon tax coming. Should the accounting standards also account for these in the financial statements?
Yes.
I think it depends on the contract. If you enter into the contract.
Yes. Yeah. If you have a contractual obligation which requires us to bear the contract carbon tax, of course we need to account for the same. And it will happen because the carbon tax is a reality now. My own personal view, I think developing countries are being treated unfairly on this. That's my view. I think we need to give time for developing countries to improve their per capita income before they are forced to bear all of these things. The developed countries are now talking about these things after having consumed the environment fully, and improving their own per capita income. So, but I think the hard reality is we can't avoid this. I think on this, these are all national commitments. A carbon tax is a reality. And consequently, as Arun mentioned, depending on the customer contracting, etc., you need to account for the same.
Yeah, MPV, if you permit me to add
please.
Yeah, see this carbon tax, which I've been observing for over a decade, the CDM approved by the UNFCCC has been securing carbon credits. And then initially, I think we had accounting issues as to what to do with it because the volatility of the pricing, kept changing year on year. And now I think there's a plan to roll it out in India. We're going to have a exchange in India, and energy like the energy exchange. We're going to have a carbon credit exchange. I think plans are already afoot on that. If you can add anything on that, and then if that will be a tool available for the companies to plan whatever climate change activities they would like to counter. Am I right, MPV? Oh.
You're right. No, I have nothing to add on that. You're right.
Next question is from Gopal. Hi, Gopal. Morning. From Dallas?
Yeah. Sorry. Hi, Arun. Good morning.
Yeah. Hi. And, thanks for joining.
Yeah, Vijay, great job. Really enjoyed.
Thank you.
And learned something as to what it is.
Thanks, he would like to know the standards that require. Are there any other regulatory requirement outside the standards that require presenting non-financial information in annual reports?
Yeah, in fact, in India, we have this requirement which has come up for the top 1,000 listed companies to present the BRSR report. It was voluntary for 21-22, mandatory for 22-23, and then with assurance as well. And non-financial, there are other places also we present. Actually, if you look at the director's report in India, we are required to give steps towards conservation of energy, how much energy we consume and things like that. That's already a report outside of the financial information. So, and those things, I would say they are already outside financial statements and they are a legal requirement. They're a legal requirement.
Great, thanks.
Vineet would like to know what size of Indian companies will attract these statutory reporting requirements related to climate change, as well as any penalty.
Whatever provisions we have described applies to all entities, including small, medium enterprises, many of them who form part of the scope 2 requirement of a larger company. So the moment an organization has committed itself for net zero target or whatever sustainability commitments to their customers, etc. They need to be accounted. And the frequency is based on the financial statements whenever you prepare. Penalty is inappropriate accounting and consequently fraud. Or I shouldn't use the word fraudulent reporting. Inappropriate reporting. Yeah, no, it's in a sense fraudulent reporting, but I don't want to use
Are these
in this
penalties
forum.
being levied currently and enforced? Or
No. It's a matter of time. It's a matter of time. It will happen.
Due course of time.
Yeah.
Good evening, Sandhya. Good to have you here. Incidentally, Sandhya, I would like to recall as the first speaker, female speaker, I think of last year.
Okay,
she's
good.
Yeah.
Good evening, Sandhya. How are you, ma?
Good, sir. Good, sir.
Good.
Her
Yes.
question
In
is
Bangalore?
on.
Yes, sir. Yes, sir.
Yeah, okay. Okay. Your video, okay, good. Our Narayana Hrudayalaya, so take care of our hearts.
Yes.
Now, many vendors are MSMEs. As we progress to 2 and 3, there's a struggle both in terms of ability to... Yeah, this is the challenge, Sandhya, all of us are going through. In fact, SEBI has given this framework of first year comply or explain, and then it becomes mandatory. And all of us are struggling to have the vendor ecosystem to do. Why vendor ecosystem? Let me tell you, the parent organization itself, measuring the data, getting the right metrics is becoming difficult. My view, it's a journey. It will take at least 4-5 years to get some amount of perfection. Only recommendation I can have is organizations should not get tempted for greenwashing, which is very, very rampant. People should realize that greenwashing can lead to severe liabilities or punishments from the Ministry of Corporate Affairs or SEBI. In fact, when you tell in your director's report or any other communication to investors, and if it is false, you are legally liable. So that's a false communication, you're legally liable. So many people think director's report communication, they have an impression it's not legal communication. But it is illegal. You are preparing it under the requirements of Companies Act. So every word you write there is a legal communication. And if it is found to be a misleading communication, then the liability certainly comes up. So I would encourage organizations to be extremely careful in making these commitments. Today, if I tell, for example, Sandhya, don't get me wrong, but for ease of convenience, let's say from a diversity, from an ESG perspective, we have this diversity, inclusive and equity kind of a thing, where there's a race to tell. We are having so much proportion women employees and things like that, and we commit to do 50% by 2030 and all. I don't think it is necessary for organizations to go that whole hog. You can be very factual. Today, I have 8% of my employees. I have 12% of my employees, etc. But you need not make those kind of commitments. Similarly on water, similarly on air pollution, all of those things. I think people have to be very cautious in making those commitments because some of these are practically very difficult to implement. There are some industries, some areas where they're feasible to do, but need not necessarily be the same in other industries.
Sure, sir. Thank you.
And then next time you're in Chennai, let us know. You come for the Heads of Finance Group meeting as well. We'll hear you. We meet every month Friday.
Sure, sir.
Come.
Sure.
Yeah. So then there's a message from Karan. So as far as the emission credits are concerned, I think as far as SIFY is concerned, we're relatively early in the journey. We currently have power consumption and water consumption for our data centers. So we have a measurable tool, measurable metric and tools available there. So we are doing that. And at present, we have taken steps only relating to energy by trying to replace it with a combination of solar and wind energy. But we are pretty early here. Early stages. We have not come to an advanced stage in terms of taking credits and things like that. We are not there as yet. Then how an organization should design policies at group level, put control in place. I think this is a fairly large task. A cross-functional group is important. many organizations I have seen, they tried to see this as a function relating to the finance team, financial reporting team, or IR team, or compliance team, or secretarial team. But this function is a CEO-driven activity, and it's a cross-functional activity. Large organizations who can afford to have a senior management person, they have a senior person driving this. The other organizations should ideally look at a small committee approach of 4 people or 5 people who can drive it in the respective functions. But the first point is, how do we measure both within the organization and supply chain? I think that's the biggest challenge all of us are going through. Then can you discuss importance of professional skepticism in audit while dealing with climate? Okay. No, I think professional skepticism is all about the estimates. Where do you apply professional skepticism? You apply it for all estimates and judgments which you make. So the current guidance, same thing continues. I think important to develop some amount of subject matter expertise to understand within the audit team, to develop that expertise, to understand how climate related matters are impacting that particular organization, and use that expertise. If it's not available within, maybe engage an expert who can help the audit team to come to those understanding. But I think bare minimum, I think we should read the director's report, the BRSR, the website, the CEO statements, communication to customers on commitments which are made. I think those things, if you read itself, it will give us enough material to discuss with management on the impact to be considered for accounting. So I think time permits. Sandhya has one more question.
Please, Sandhya, please
on
go
recent,
ahead.
on recent commitments, comments
Valuable
made
time.
by reputed professor values that means compromise. Yeah, Sandhya, the point is understood. See, what happens on ESG, what happens, it comes at a cost. It comes at a cost. So obviously it does impact valuation, but we should also understand that there's a changing investor profile. There's a changing investor profile where the new set of investors are happier with lower returns when the organizations are ESG compliant. So they're not saying that that organization is generating high profits and it is harmful to society. I will put my money there. And we are seeing companies which are very respected multinational company, let us say in India itself, who have moved away from a product which is considered unhealthy to food products, to hospitality, how their transition has taken place, where the unhealthy habit-related product they have shrunk it both in terms of percentage of total volume. So organizations are taking that to ensure that shareholders still get that overall good return. But what he said is correct. It will definitely have that bit of impact.
Just trying to gather some more info. It's my question actually. There's nothing else left. Just a minute or so.
Sure.
Just I saw that a week back, California enacted a broad climate disclosure law. Perhaps you would also been aware about this Climate Corporate Data Accountability Act. Do you believe that we are also going to have a series of such intensive measures, similar and
100%. It will happen. It's just a matter of time. Just like we have the data protection law, which is now come in. So similar legislative framework will come.
Okay.
And many of us are actually in India suppliers to those companies in US who are subject to that law. So indirectly it would again also impact as well.
Okay.
Yeah.
If I may add here, I think Arun, just adding on to what you were sharing, I believe this climate change and related regulations are going to have series of circulars, notification, acts. It's like going to be a total different bucket of regulations altogether. And obviously, first few years, we are going to see companies not able to understand. Even the consultants are not able to understand that. Like we saw in GST, you, Sandhya, MPV, all of us have really been through that for the last few years, trying to figure out what it really means before we even convey to our clients and companies. So MPV, I believe you would also tend to agree that, it's just the starting of a blackout phase, so to say, even before we get a clarity.
Yeah. And I would only, I've been talking to the regulators whenever I get the opportunity, telling that it's important to have a particular glide path or a landing period, which should be a reasonably long period. We shouldn't do it because India is a developing country. It's not a developed country as yet. So you need to give that bit of time. You can't choke people. We should be reasonable. In fact, my view, it's moving very fast. It's moving very fast. They've gone off to assurance now and rating. So what happens is indirectly pressure builds on organization. Take Narayana Hrudayalaya itself. There'll be so much of pressure if let us say one hospital does it. They say we got a ESG rating. Now I can't say I will not do. So I'll also have to do. So if that hospital has a particular commitment, I also need to do. So there's a unfortunate pressure, peer pressure building up, which we have to balance it actually. I'm not too comfortable with the speed at which it's going on. I'm not able to measure, and we are talking about audit already, or assurance. So, and they talk about reasonable assurance.
Now, just to recap, especially you had highlighted the aspect that there is no need for any additional disclosure standards specifically because the whole thing is going to be a subjective assessment. So given that kind of background, I see that it is going to provide a lot of opportunities for professionals to support. At the same time, I think it will be kind of a niche market to be addressed by early adopters of all this. Like we had the black box approach, Black and Scholes model for valuation decades back. Only though they knew, they said, okay, this is fine, and then thereafter everything failed. This is my actual concern with this accounting standards, migrating towards totally being judgmental on so many aspects. How do I compare A company with a B company in the same industry with so much subjectivity? That is, I mean, as a professional, I've been worried about it. Not that I can do much about it, except, but I see the opportunity at the same time.
Arun, the answer is the following. One is, don't consider all of these and compare financial statements. You'll get financial statements which are totally irrelevant. Versus, consider all of these things which impact an organization. Get that expertise to understand. My view, investors are people who are supposed to build that expertise. It's not meant for a common man. Please don't get me wrong. Just like a medical report, let's say an ECG diagram or whatever, it is not meant for a common person to know. It's meant for the people in the medical fraternity to understand how that report has to be read. Similarly, financial statements, including notes, are to be read by people who have an understanding of what goes into preparation of financial statements. Only they should do it. That is why institutional investors and the need for retail investors to come through the institutional investments, through mutual funds, etc. Only then it will do it. So if people want to just look at PAT number and invest, PAT, CAGR and invest and all, those will not work. So we have to see which is the better evil of the two.
Thank you. I think there's
I think we should not.
I'll just take the last question. I think it's a quick one. Shambhavi is writing whether we need to have a business-wise vertical reporting.
Correct.
Not really, actually. When you have let's say, for example, you're already having a segment report, and if this climate matter impacts a segment, it obviously will form part of that segment income statement. So we don't require again separately.
Sure. Thank you.
And we have another one, last one. I'm sorry, just
good evening, sir.
I think.
Sorry to interrupt. Shambhavi here, sir. Good evening, sir.
Hi.
What I wanted to ask was not in terms of reporting. See, for example, if we have a big conglomerate with various kinds of businesses, so in that case, do we need to have a vertical-wise evaluation? A construction
obviously.
industry may have a different impact compared to, say, a defense. Or
obviously,
like
Shambhavi. Obviously, Shambhavi, you are L&T Shambhavi, no?
Yes, sir. Yes, sir. Good evening, sir.
Okay. Good to see you. Good to hear you after a long time. So
Thank you,
yeah,
sir.
so it has to obviously be done business vertical wise.
Okay, sir. And as you rightly pointed
Evaluation.
out, it will not be only a F&A specific evaluation. So we need to have a cross-functional team,
It's
and
a
it has
cross
to be
function.
led at
Yes,
it.
yes, 100%. 100%. 100%.
Thank you so much, sir. Nice to connect to you
Yeah,
today.
yeah.
Thank you.
So good to see Manish is also on the call
Yeah, he
today.
has got.
And yeah. So I agree with your observation, Manish. No disconnect on what you have said in the chat box. Okay.
Thank you. I
Thank you
think
all.
I
Thank
think
you
I
all.
have retained you for longer than originally
No.
planned. I think it's a great privilege for us to have with us, and I look forward to the next session. We have got a fantastic bird's eye view of the impending changes and although the steps that need to be taken as senior professionals in the various sphere of activities we are engaged with. And it's been a great guide for us to gives us a perspective as to the impact of this that is going to happen in the next decade or so, starting with this year. So I look forward to for another session, as you rightly pointed out. I'll discuss with you the timing and this thing. And thank you so much.
We can do a session on IFRS sustainability standard 1 and 2, the two standards.
Okay, great, fantastic. Thank you. Topic is set, so we'll fix up the timing. I'll have a discussion.
And sir, it will be helpful if you could have a couple of illustrations from the practical perspective in terms of which companies and
like you had done right now one reporting in terms of that. No?
Yeah, for this I had illustrations.
Absolutely.
But IFRS S1, S2, they are mandatory only from 23. I don't know where. Maybe we'll get it next year or so. We'll see.
Okay.
Right. Okay.
Thank you. Thanks all for joining us today and spending time with us.